Hello, I'm Brian Zen. I teach investment analysis at St. John's University. I also manage money for private and institutional clients at a New York investment firm. I've earned an MBA in accounting and PhD in finance and passed all the 3 CFA exams. In this study session, we talk about 2 methods to value equities, the dividend discount model and the cash flow model. First, we have to understand the differences between the dividend discount model, the cash flow model, and the residual income model. When you use dividend discount models, there are a couple of advantages. First, dividends are what you receive as a long-term passive stockholder. Secondly, dividends are less volatile than net income. Thirdly, it can, in theory, apply to non-dividend paying companies because eventually those dividends must come out. You can estimate the terminal value 10 years or 20 years down the road, and assuming there's no dividend for the first 10 or 20 years, and then you can apply an appropriate discount rate to discount that terminal value to the present value. Those are the 3 advantages of using the dividend discount model. However, we have 2 major problems using the DDM, dividend discount model. Firstly, not all companies pay dividends. Secondly, when those companies do not pay dividend, you have to estimate a terminal value 20 years down the road and discount that terminal value to the present, and that is a pretty big challenge. There are a couple of situations that is appropriate to apply the dividend discount model. And those situations are for dividend-paying companies. If a company pays a consistent dividend, and if those dividend relates well to the net income, it would be very appropriate to use the DDM model to value those companies. Secondly, DDM applies well from a perspective of a non-controlling shareholder, because only the controlling shareholder has access to the company's cash flow. Next, we look at the cash flow model to evaluate a company. There are a couple of advantages when you use the cash flow model. Firstly, it is good for non-dividend paying companies. Secondly, the cash flow relates better with the company's economic earnings power, because some companies pay a very high dividend, some companies pay a very low dividend, and cash flow reflects the reality better. Thirdly, cash flow model is better from a perspective of a controlling shareholder, because you can fire the CEO, you can control the company, and look into the cash register to dig into the cash flow. There are a couple of problems using the cash flow model. Firstly, you have a couple of versions of cash flow. We're going to talk about different formulas about calculating the free cash flow to the firm and free cash flow to the equity, and those formulas are pretty nasty. Secondly, from a non-controlling shareholders' perspective, those guys couldn't get into the cash flow. So the cash flow model is not good for non-controlling shareholders. Thirdly, sometimes when a company is in a development stage, the free cash flow is usually negative. And for those companies who have a high capital expenditure, the free cash flow for those firms are negative also. So in those situations, free cash flow model would be difficult to apply. There are a couple of situations that are appropriate for you to use the free cash flow model to value companies. And those situations are, first, for companies that pays no dividend or with no dividend history. Secondly, it is appropriate for companies where the dividend payout policy doesn't relate to the economic earnings power or the company's real cash flow situation. So in those situations, looking at the cash flow is a good method. Thirdly, from a controlling shareholder's perspective, cash flow model is definitely better. Next, we look at the residual income model. For residual income model, there are a couple of advantages. First, it applies to dividend-paying companies, non-dividend paying companies, and even negative free cash flow companies. Because here, you are looking at the excess return above the required return on equity capital. And you are discounting the excess residual terminal value into the present. It doesn't matter whether your company pay a dividend, doesn't pay a dividend, or even if you have a negative cash flow, we can still use the residual income model. And the second major advantage is when you use the residual income model, it doesn't matter whether you are a controlling shareholder or a non-controlling shareholder. However, we have problems with residual income method also. First, it is very difficult to apply because you have to look into the different accounting methods. You have to work through the earnings manipulation techniques of the management to find out the real earnings that's economically returned to the shareholders. So you have to look through the accounting earnings and search for the economic earnings. Secondly, you must estimate the required return for shareholders. And that's a challenging task for you to estimate what is required by the shareholders of this company. What do they require as their return on the capital? There are two situations that are appropriate to use the residual income model. Firstly, it's good for companies paying dividend or not paying dividend. So it applies to both situations. Secondly, it applies to both positive cash flow companies and negative cash flow companies. As we said before, for all the three methods, one of the key is to calculate the cost of equity. The cost of equity is the required return by the shareholders that they need to get from this company. The first method is use the capital asset pricing model. When you use the capital asset pricing model, this is the formula that we have all remembered at level 1. Essentially, we have to estimate the stock's beta. Let's say the stock has a beta of 1.2. Then we look at the expected return of the market. Let's say the market has an expected return of 15%. Then you look at the risk-free bond return, those treasury bonds, and usually people look at 10-year treasury bond return, and let's say that is 10%. So you use 15% market return minus 10% of the risk-free rate, you get a 5%. That is your market risk premium. Market risk premium. That 5% multiplied by beta 1.2 plus the 10% of the risk-free rate, you would get a sum for the required return of your common stock. That's the capital asset pricing model. The key assumption using the CAPM model is that the only risk factor, the only risk premium comes from the market volatility. You look at how volatile that company's stock is, and then you determine what excess return you require from this stock.